All right, we're going to go ahead and get started. Welcome everyone to our 2021 Economic Outlook webinar. Thank you for being here. I'm Matt Dwyer, Principal at Matthews, Carter & Boyce CPAs in Fairfax, Virginia. MCB has been hosting this event for 7 years, and we welcome back the renowned economist, Dr. Terry Clower. His annual Economic Outlook is always a highlight of the new year. This year we have over 200 people in attendance, so again, thank you all for joining. I would also like to thank our co-sponsor, Atlantic Union Bank. Their commitment and support of this event is much appreciated. As you know, the new stimulus legislation was passed at the end of 2020, establishing a second round of PPP loans for small businesses and providing new tax and loan forgiveness guidance. Please contact Atlantic Union Bank if you need a PPP loan, or contact an MCB advisor if you have PPP loan forgiveness or tax-related questions. Before we start, a few housekeeping items. This event's scheduled to be an hour and a half. We'll reserve the last 15 to 20 minutes for a Q&A session. Please use the chat feature to send questions during Dr. Clower's presentation to my colleague, Cindy Park, who will accumulate the questions and ask as many as we can at the end of the presentation. After the session, we will send an email to all registrants with a link to the recording of this webinar and contact information for both Atlantic Union Bank and MCB. So now let me introduce our esteemed presenter for today's event, Dr. Terry Clower. Dr. Clower is the Northern Virginia Chair and Professor of Public Policy at George Mason University, and is also the Director of GMU's Center for Regional Analysis. The center provides economic and public policy research services to local governments and businesses, primarily located in the Washington, D.C. metro area. Prior to joining GMU, Dr. Clower was Director for the Center of Economic Development and Research at the University of North Texas. Today, Dr. Clower will provide us insights into the economic trends in Fairfax County, the greater Washington area, and across the country. Now it's my pleasure to turn the presentation over to Dr. Terry Clower.
Thank you very much, Matt, and welcome everybody. I know there's absolutely nothing going on in the world today that would be competing for your attention, but we hope to present you with some general information about what's going on, what has been going on, put some context to some of the data that you've been hearing, and then have a little bit of a lookout on what we see happening. This is a little different, obviously, than our normal presentation that we would be discussing with you folks, obviously, from the sense that we're not, unfortunately, able to be together and have that dynamic that we usually do in these presentations. And also, I think it's very important to understand that moving forward into 2021 and beyond, there are so many different caveats that you have to put on forecasts that we're a little bit hesitant to talk about specific numbers, but we're going to look at overall trend lines and what's been happening to hopefully give you a sense of what you might generally expect, though many of you are operating in segments of the economy that have had very differential impacts, and we'll talk about that as we go through. So diving right in, what we're going to do is talk about the national economy for a bit. We're then going to focus on the regional economy and then do some special look out on some key challenges as we move forward, and then get into our Q&A session. And you already know the title of it. So gross domestic product has been just hammered. The economy had actually already started a little bit of a downturn in the first quarter of this year before the effects of the pandemic really started to hit us in March. If you remember, in that mid-March and then early April when we were having lockdowns and all this. And this, of course, had a tremendous impact on our economy. You can look at those numbers, those last couple of bars in that, where you're talking about over 30% decline in gross domestic product on an annualized basis. And that just means that if the change from quarter one to quarter two were annualized, that's the kind of percentage drop you would see. Now, of course, then we saw a massive spring back, and we started some of that recovery in late May as some governors started to undo some of the restrictions on movement and business activities. But we also saw what was happening was the degree of resilience that we were beginning to see emerge in some of our sectors of our economy. Retail, Some hospitality industries, though, certainly hammered. And we'll talk more about that. You even think about the housing market. So, housing activity pretty much came to a halt for a few weeks. But then we started figuring out how to do that, how to do virtual tours of houses, how to do the transactional processes in a more virtual, less in-person environment. So there was adaptation, and you probably have seen this in your industries as well. One of the key things, though, I would point to is that it's headline news to talk about that percentage change from on an annualized basis from quarter to quarter, but you also have to keep the context. So, and I just think about this, your basic stats. If you had $100 and you lost 30% of it, that would be $30. But if you gained 30 off of that bottom, if you're now at $70 and you had a 30% gain, you're only back $21, right? So what we see, if you'll look at that light green line, you'll note that we are still substantially below what the economy was running throughout 2020, throughout 2019. In fact, we're back to basically about the second quarter of 2018. So we lost, in dollar terms, a full year and a half, year and 3/4 worth of economic growth. The payroll jobs, of course, all of our charts, and one of our great challenges that those of us that do these kind of presentations have is that the numbers in March and April were so horrendously bad that it screws up your presentations. Everything else kind of falls into insignificance, as you can see at this line. But we saw a tremendous hit that we have never seen before. I mean, even the Great Depression, the stock market crash of 1929, I guess it was. We're just seeing huge payroll job losses, and this has created, of course, a lot of distress in the economy. And keep in mind, this is payroll jobs, so these are not the people who would be working as contract workers, gig workers. These are people who are in the unemployment system registry in one way or another. They are counted as employees of firms. So if you will, the numbers were actually substantially larger than that. But what we have seen then is a bounce back, and note that term, what we saw in the early summer, that we saw some real springbacks as we went. But what has happened, of course, if you look at that green line, is that our job growth has somewhat petered out. In fact, we saw in November to December time period an actual loss of 140,000 payroll jobs. So unfortunately, that post-holiday reemergence of the virus, and I guess it never went away. So let's just say another surge of infection rates, and us having to respond to that with additional business closures or restrictions, then it's just been a real problem, obviously. And if you think about this in the longer term, and it depends on when you want to do your cutbacks, but our total employment level is now back to levels at probably about 2011. It goes back beyond what we actually have in this chart. So if you will, we've lost a decade of job growth, roughly speaking. In terms of our claims for unemployment, initial claims, this is a number that we've been focusing a lot more on. Usually I don't pay a whole lot of attention to this data other than just overall trend lines. But the initial claims for unemployment became very important as we were looking at monitoring what was happening with the economy, simply because it's more real time. We get this data on a weekly basis with a relatively short 1 week lag, unlike your employment situation data overall from the BLS that comes out monthly, or even data that doesn't at a regional level come out until quarterly type of data. So this is really pointing to us our need now for understanding that things can happen in the economy where we need data that is not a month old. We need data that is as recent a vintage as absolutely possible. But what you saw is a huge spike in unemployment claims. And again, this is people who traditionally would qualify for unemployment. What we have seen more recently is that the number again is starting to spike up. You look at the last part of that green line on your chart there, you see that we're seeing an increase at the end of the year. The other thing that I would want to caution you about is, so that SA in the chart there, seasonal, that's seasonally adjusted. We continue to report data at the national level that have gone through a statistical adjustment for seasonal patterns. But of course, as you well know, this pandemic has created something that we haven't seen in any kind of seasonal data. So let me just give you an illustration of that. Where the seasonally adjusted new claims for unemployment for the week of January 2nd was 787,000, the actual real number, not seasonally adjusted, was 922,000. Normally what you would see, and the reason the number is smaller than the season adjusted is normally coming out of the holiday season, there are people that worked at the retail outlets and other places that were basically holiday jobs, and then they go back into the unemployment system in January as those jobs disappear. So you see that adjustment between the seasonal average. However, the reason I bring it up and to talk about the importance of understanding that at this particular point in time, the seasonal adjusted is understating the magnitude of the problem. If you're one of those, that differential of about 140,000 people, it's very important to you that you are now unemployed. In terms of continuing claims, right now our numbers are running at something in excess of 19 million people in the United States that are on some form or fashion of unemployment assistance. And this includes the special programs that Congress has just recently said that they're going to continue. You had a lot of people that were starting to fall off of that special programs. The pandemic emergency unemployment at this point is about 4.5 million people. And these are people that would have had jobs, part-time jobs, gig worker jobs, contract jobs that wouldn't have necessarily qualified for unemployment insurance, that we've done these special programs now to get them some benefits. But again, this is just something that we have not seen in a long, long time. Now, mind you, our unemployment rates that I'll talk about in just a moment are not as bad as they have hit in some periods of time, like the Great Depression. And here you get this thing about, the terminology. Are we in a recession or a depression? Well, the numbers, as I'm going to speak to you, really say we have a very mixed bag of what's going on. The unemployment rate that I talked a little bit certainly spiked up to at one point almost hitting 15%. The two different numbers that you see there, the dark green is our usual headline unemployment rate. The light green line, as I have used before in this presentation, is the U6 rate. And what that does is adjust for folks that are working part-time that would rather be working full-time. So in this case, we think about somebody that was working in the hospitality sector, say they were working at a restaurant, and while they did not lose their job, the reduced hours of operations mean that they now have a part-time job and they would rather be working full-time. So we see those differentials. And the important thing that I would note here is if you look at that, the way those bands work in that upper chart here, the gap, or if you will, the relative increase in the total employment between the unemployment rate, the headline rate, and the U6 rate had been actually narrowing. We had gotten to a point where more people who wanted full-time jobs were finding full-time jobs. But of course, that spread has spiked up now. So if you count those folks in, the unemployment rate is closer to that 11.7% that we're showing there for December. And that gap is increased. The one, though, that is more concerning to economists as we look in the long term on this is that bottom line, is that bottom chart, the labor force participation rate. So the labor force participation rate, these were the folks that were out of work that quit looking for jobs. So you lose your job in the hospitality sector and you just say, I don't know what else to do. I'm not looking for work, because you still have to be actively looking for work to count as unemployed. And you'll note that we had the massive drop And in these, now keep in mind your scale here, but this is a problem that has been persisting for a while. If we go back in time to before the Great Recession, the labor force participation rate was closer to 65, 66% in that general range. After the Great Recession, we lost some of the folks. Now, some of that is because of an aging population, baby boomers who are aging out of the workforce, no longer looking. And of course, are a big cohort of people that changes that dynamic. But what we're seeing now is that while we had a bit of a rebound in summertime in the labor force participation rate, since then we've kind of just been running in that, and we've kind of flatlined out. This has implications for overall wealth growth, for personal income growth. It has, if we wind up losing people out of the workforce on a more permanent basis because of an enduring problem related to the pandemic, then we can expect overall economic performance and GDP growth to be slowed over what it otherwise would be. So again, we're monitoring this pretty carefully. But again, it's this thing that we need to figure out ways of getting people, as the economy starts to recover, as the vaccines get distributed and get put in place, that we want to get people back actively engaged. We don't want them to be permanently withdrawn from the workforce for all sorts of broad economic reasons. So let's start unpacking this by sector of the economy. And as this would say, with the exception on a year-over-year basis, with the exception of federal government, every major sector of our economy lost jobs. Now, there are some details of this that we want to get into in a little bit. The biggest hit was in leisure and hospitality sectors, so hotels, restaurants, entertainment venues, those kind of things that you would expect. Retail trade took a hit, though some of that is shifting. Remember that we've talked about this before in previous years. For those of you that are that have attended before, that it's getting real difficult to categorize some jobs. In other words, if you're working for Amazon, are you a technology employee? Are you a retail employee? Are you a distribution transportation employee? So you get some categorization challenges that we have here. But the point is that this was a broad sector response, and it hit our heaviest. Education and health services. It was really an interesting thing that we entered into a pandemic, a health crisis, and yet we saw hospitals laying off people because of elective procedures. We couldn't, we weren't allowing elective and those kind of procedures go, and even some things that are on the verge of not being particularly elective. We were delaying or putting off when people were having certain things like a knee replacement surgery, other arthroscopic procedures, whatever it might have been. And that had an outside effect on the industry because many of our healthcare providers gain most of their profitability out of those elective procedures as opposed to more standardized recurring medicine. Obviously, the education sector was hammered. Now, in this case, education here is private education. This is not public sector. This is not our public school systems, but education, private schools, private universities, those kind of things, they got hammered in this and had staff that went under various degrees of separation, either temporary or permanent separation because of loss of income and loss of having classroom experiences, people going, basically attending class. The other thing that I think is real interesting, and it points out something that, depending on your outlook of government responsibility, is a real interesting phenomenon. But one of the big challenges that we saw emerge in March and April of last year was issues of food for low-income families. It has turned out that over the years and through our policies, that providing food for low-income families has largely fallen to school districts through the subsidized and free lunch programs, free breakfast programs, and even these things that some districts are doing, things that provide food for kids to take home over the weekends. And all of a sudden in March, that system just disappeared. And so it was a real challenge as school districts themselves were having to figure out how are we going to help make sure that these children have access to lunch, to a dinner. So and it really points to some interesting things about the way we structure our economy. And we're not even going to get into the broader debate that could say about the issue of where we get our healthcare, because when you have your healthcare tied specifically to employment, to your workplace, to your particular employer, when you have massive scale disruptions, then you can see some real challenges emerging. Some of the other sectors that you would see, that you would expect in terms of loss, transportation and utilities, and particularly transportation sector, did not see on a year-to-year basis as big of a downturn, in part because we started shopping from home. This is one of our measures of economic resilience. Consumers found new outlets and different ways of spending their money. And of course, one of the real questions that we'll talk about later in the session will be the thing about how much will some of that come back? What is the shape of retail moving forward? How much of your grocery shopping are you quite content to have be done by somebody basically doing the shopping for you, and you either pick it up outside or delivering to your doorstep? Federal government increasing. Of course, we saw an expansion of federal government spending continuing on, but also that number is affected a little bit by the surge of employment that occurred because of taking the census in 2020. So, and of course, and that continues to have a somewhat positive impact on federal government, though a lot of those actual census takers obviously are now back in, are no longer employed by federal government. I bring this next one up, not that I'm paying as much attention to it as I would have in previous presentations, but you'll notice that there was a real bump up in average weekly earnings earlier this year, and that they've actually, the slopes of the line, it's a little hard to tell, but in that green line, it's, it's the shape, or if you will, the slope of the line is a little bit steeper than it was previously. Having said that, the reason we saw this is not aggregate total earnings, it's average earnings. And so the message here, and you've heard it said before, remember back to that previous slide where we were talking about the industries that lost wages. The industries that were hit the hardest are typically lower paying industries. So this gain is not so much in that the folks were seeing increases in their paychecks across the board like this number would suggest otherwise. It was because on average, the jobs that were left were the higher paying jobs. So it's a statistical artifact. And as we go forward, there's going to be a lot of reasons that all of our data moving forward, when we look at 2020, there's going to have to be some kind of an asterisk next to it that just says, yeah, but, this data was interesting, but it doesn't tell the story that it normally would tell. In looking at more recent trends, I want to look at a couple of month-to-month changes. So from October to November, we were seeing some job gains that were pretty broad. The exception being federal government starting to shed census workers. The information sector it's kind of interesting. That sector of the economy is kind of strange in its performance, but remember that that contains things like publishing industries, which a lot of those industries were just hampered because of production processes. So, production of books, magazines, things like that. There was a good number of job layoffs, both temporary and permanent. The continued contraction of the newspaper industry in our country as more people are consuming their news and broader national sources as opposed to local papers, all of that. And then a substantial hit in state and local government. One of the things that is a key issue that we will talk about in the outlook is the degree to which the current administration at the federal level has, and the Republicans in the Senate have not wanted to have any kind of specific broad-based bailout money for local governments. state governments have certainly seen a good bit of money coming in, but local governments, based on their tax structure, where sales taxes are more directly important, versus say income taxes in Virginia or Maryland or the District of Columbia, it's just been that state and local governments have seen significant disruption in their revenues, and they've been having to really scramble to keep from doing massive layoffs. Many have done layoffs. Some are just furloughs, temporary layoffs, and some are more permanent in basis. And this is something that we presume will change in the new administration and that outlook, but there is substantial risk still in that sector. But that was October to November. Now let's look at the November to December, and what you see is that several sectors of our economy started to contract again. And again, this is when we started to see an increase in the restrictions placed on businesses because of the post-holiday surge in the infection rate for coronavirus. Education, health services down again. State and local government, of course, that is continuing that trend. Leisure and hospitality took a big dip, and then the other services is pretty small, so that's a little hard to tell much out of that. But you saw that we started losing again what we had gained back, simply because folks traveled, were maybe not as cautious as they could have been, and the infection rates have expanded. In fact, we're continuing to see that now. In fact, I would expect, of course, we're not going to get the numbers for January for another few weeks now, but I would expect that we'll see that trend continuing. Here in Maryland and Virginia, we've seen an uptick in the restrictions, and I think we're in for another surge that's not going to be fixed by the distribution of the vaccine yet. Again, more on that later. Labor productivity has really bounced up a lot, but notice where you have spikes in labor productivity gains. So you get productivity gains in times when there are significant numbers of layoffs happening. And this is just an artifact, fewer people that are there, but the businesses are, it's kind of that cart before the horse of which way does it go in terms of the revenue. So these productivity gains, again, would suggest, something that's strong for the economy in the long run, but this is a bit of an artifact of what we see at the moment. What I will tell you, though, is that it's going to be tougher to measure productivity in an era where we're continuing to see the growth of online shopping, entertainment coming in an online basis, because it just changes some of the dynamics in ways that our data gathering processes are not fully accounting for yet. And of course, the emergence of new technologies that we have going forward are going to change that as well. Even if you think about the extent of the continuing emergence of electric vehicles changes some of the structure of our economy in terms of demand for, say, oil and gas production. It hasn't been a huge thing yet, but it is emerging that way. But our productivity numbers and the way we measure the economy, it's still a little trapped in the old days of the way we weight some of the economic measures. So we have adjustments to be made in our data. Consumer confidence, interestingly, expectations that look out about 6 months certainly are down, but did not take as big a drop as you would otherwise have thought they might have been. This is nothing in terms of expectations like what we saw in the Great Recession, where those numbers dropped down substantially lower than what we even show here in this chart. Certainly the present situation index took a real hit, and it is affecting sales. We have people that are simply saving more money. They're paying off debt. They're being a little more cautious while still spending some money. But this is that whole explanation of why GDP has not recovered and is not going to recover for a while. Folks are just very cautious. What we did see is that folks at the high end sectors did not lose their jobs, did not lose their income, and they're continuing forward. That does not mean that they're not being cautious in some of their spending or haven't found out how to otherwise shift their spending quite completely. And we can talk about that as we get more into other sectors of the economy. Home sales, this is the one area that really illustrates the what has been described as the K shape, if you will. So think of the K, where folks at the lower sector have gone down and people at the upper sector continue to go on. Folks um, that could afford homes were still in the housing market. Folks that were renters were where the concentration of job losses have been. Obviously, that's a very broad statement, and I know very well that there are specific examples of industries that has not been true for. But we saw that having that dip down there in March and April, we figured out a way to do the business of real estate remotely. We can, if you think about it, there were a good number of people in the financial transaction side of the real estate sector who had really resisted DocuSign, electronic signatures and stuff like that. They just didn't like it. They didn't believe in it. Well, I don't think there's any of those folks left in the business, or if they are, they got to be struggling because, you can do all of this activity now remotely, virtually. We recently, my wife and I moved in mid-December. We sold a house, and I'll talk a little bit more about that particular case study when I talk about the regional market. But the person that managed our closing drove up in front of our house, did not even come into the driveway, walked up to our house, handed us some documents, and retreated back and sat in the car, and we talked through them on the phone. That was the closest contact we had for our documentation when we sold our house. But we see that this is going to, if anything, the constraint on this being larger has been an issue of inventories, which we will talk about at the regional level in more detail. But you see a surge in new home sales and then a drop off, and some of that's just a matter that construction has been constrained, if nothing else, based on materials. We are also seeing substantial inflation in cost of building materials because of demand. Now, some of this, it's kind of spread through the economy, if you will, because the other thing that we are seeing, if you are in the business of remodeling, things on average for that industry are looking very, very good right now, simply because folks are not going on trips or doing other things, and they're remodeling their house. And they're remodeling their house either because they choosing how they spend the money, or doing some remodeling for as we are doing here, work from home, learning at home, etc. So the remodeling sector has just been going great guns here recently, but that has put constraints on materials, both in terms of demand and then, of course, disruptions that we saw in the supply chain for materials during the height of the pandemic impacts. And some of that was, where we've taken some of those industries and have declared them essential, but they still have had problems about infections on site, having to lose workers, temporarily because of infections, et cetera. Moving now to the regional economy, our job market here certainly took a hit. Proportionately, we were not hit as hard as some other regions of the country, but we didn't do as well as some other areas. But this is where federal government really, gave us an underpinning. If you think about the last time we experienced a regional recession was back in 2013, 2014, when the Budget Control Act was implemented, and we saw that decrease in federal spending, very much driving that. So at that time, you might remember these stats from earlier year presentations, that in 2010, the federal government was about 40% of our regional economy. We had whittled that down in 2019 to probably something in the neighborhood of about 33%, 33.5%. So a pretty good shift in a fairly short period of time. But of course, that has surged back now as other sectors in the federal government employment stayed strong, federal spending kept up. Still, if you will, we're down, and November is the last data that we have at the regional level, down about 180,000 jobs. To put that in context, so we see, if you look at those bar lines there to the left of the big drop, we were hitting, for some periods of months of getting around 50,000. So a good year for us is about 50,000 job growth year over year. that would indicate that we've lost about 3.5 years worth of job growth in a very short period of time. And this is coming off the bottom. Obviously, it was worse in April and May, March and April, and then of course has improved somewhat. But you'll also notice that the number, if you look at that very last downward trending blue bar, is that it's actually gotten a little bit worse in November versus October. Between our sub-regional levels, but as I've spoken before, and you've heard me use the kind of what's probably getting a little tired of the joke about the Potomac Ocean, but if we look between DC, Southern Maryland, and Northern Virginia, that all of our regions have lost some jobs. DC looks there to be a little bit less, but they're a smaller base. So job losses in DC have been actually on a percentage basis a little bit worse than either Maryland, Southern Maryland suburbs, or Northern Virginia. But nonetheless, the only point here is that we're all been suffering. And you'll note that just the shape of the line, that gap there on the blue bar that represents Northern Virginia, our most recent job losses are actually a little bit worse. And I'm going to talk about some structural issues here later in the presentation that might help explain that. Just as a reminder, as we're looking at that, professional and business services is about 24% of our overall employment. Education and health services, again, private education and health services is 13%. Federal government is the third largest employer. State and local government is fourth, on down. So leisure and hospitality took a real hit. It's our fifth largest industry. Imagine, if you will, if we were some of these more rural communities, whether in Virginia or elsewhere across the country, whose 75, 80% of their economy is based on tourism. Just imagine the pain that they're going through in all this. Manufacturing very low, obviously at the bottom there. So then if we start thinking about within that of just looking at how this has kind of gone on November to November by industry sector, professional business services is down. I'm going to talk about that more in just a moment. Education, private education, health services still being impacted, both in terms of medical profession as well as private education, not having to, if you don't have kids in the building, then you don't need janitors, you don't need other folks, other support staff. State and local government down. Obviously, the hit in leisure and hospitality that we talked about. Interestingly, note that construction is gone because construction is considered an essential job category, and wholesale trade has grown regionally. And that wholesale trade, of course, is part of what's supporting our shift in retail to more online local delivery platforms. Transport and utilities is a little bit of an anomaly. It's something to do about where jobs are based, but nonetheless, we have seen some decline here regionally. Also keeping in mind the relative value of these jobs. So if you think about it in this way, on average, in that business professional services, we've lost, something less than 16,000 jobs there. But to put that in equivalent, that would be, in terms of value added, about like losing, say, 45, 50,000 jobs in leisure and hospitality because of the value added per job on average. In our most recent time period, again, we're seeing that professional business services has actually grown a little bit regionally. We saw some private education and health services regaining. Retail trade actually kicked up a little bit in our region. And then you see these others. And we actually saw from October to November a little bit of gain in leisure and hospitality. That when November is the last data that we have, I fully expect that we will see that retail is dropping back. This is somewhat reflective of holiday hiring, the Christmas season hiring. And then of course, some of these other sectors like leisure and hospitality have actually gone, every one of our anecdotal numbers is telling us that number's gone negative again in what will be the November to December period. Professional and business services overall, I think it's really important to think about the value of this. So this is where A lot of our contractors, government contractors are showing up, whether it's the military contractors or technology contractors. But professional and business services is a very, very broad sector of the economy. Now it's down a lot. Again, that these are, high on average, these are high value added jobs to be had. And we've seen, again, we saw the drop down in the early part of the year. We saw some recovery, but then we've lost some steam, if you will, in that November period. So we're down about, again, 16,000 that we talked about. But I want to separate this out. As I mentioned, professional business services is actually a very broad sector that includes engineers, computer programmers, attorneys, architects, other high-end services, but it also includes things like personnel services, security guards, services to buildings, waste management services. So if we separate this out a little bit, what we see is this interesting phenomenon that has happened here is that we've continued in our sectors, professional services like computer programming, engineering, architecture, those kind of things. Throughout the pandemic, month to month, we've been creating jobs. Where we have lost jobs has been in that administrative services, security, personnel services, waste management. And again, that's the lower value. So that K shape that I talked about before is still in play here. But what this really is kind of indicating to us is this is indicative to me of the strength of maintaining federal government spending going on. So while I'm very much, as you know, a proponent of us separating ourselves more from federal dependency on federal government and our industrial structure, this is one where I think we've been supported by continuing contracts that have gone on in this region because of that. We have also seen gains in our sectors like data centers and all this. And I know this question is likely to come up, but I will say now that this continued growth has little to do at this point with Amazon HQ2. Certainly they've added some jobs, but you're talking about, I think the last number I had was something about like 1,200 jobs or something like that. That may be off a few hundred, but the shape of this line here, these bars, does not change at all based on Amazon HQ2 yet. What we are seeing is other sectors of the economy. Keeping in mind, and depending on who you talk to, you get wildly different numbers. But before HQ2 was announced as being here in this region, and particularly Arlington and Alexandria area, Amazon Web Services already had, by some counts, over 10,000 workers in it. They don't I don't know what their exact number is, but I've had some of their vendors have said that that number is between 10 and 12,000, and it might be higher than that. And if any of you guys know a specific number on that, please put it into the chat function, or we can talk about it in the Q&A. So here's our numbers on leisure and hospitality, and you can kind of see the hit. I mean, think about this. For all saying that our regional economy has certainly had a hit, we're not, in dire straits as we might otherwise have been. We have a lot of people who have lost their livelihoods. And think about this. These are jobs that represent households who probably don't have a lot of financial buffer. They do not have, big savings accounts or something, that you might expect of other workers. So this is a lot of pain that we're talking about for these folks. And indeed, I'm working with some folks on some ideas for programs to help this specific group of folks, and we'll talk about that more later if we have time. And I just wanted to break this down just so you can kind of see individually some of those numbers as opposed to just the chart. So, down in the time periods, 158,000 jobs, 130,000, 108, so it's down. But what we saw is that even during the summer months, we had some real declines in there, and it's just been problematic. The number here, it's not a huge change. We saw a little bit of, if you will, of that, but it's still, these are just horrendous numbers. Unemployment rates compared to the national average, what we've seen is a real shift in Southern Maryland, where Southern Maryland, which is the if you will, that kind of, I'm not sure what I'd call that, a goldish color. So we'll call them gold. It runs historically substantially below the red line, which is the US average, getting a little closer, a little closer, a little closer. But what you see now is that Southern Maryland and DC both are above the national rate for unemployment. And what's interesting, it's pretty standard and very common, this blue line for DC, the top blue line, that dark blue line, for DC to have a higher unemployment rate than the national average. That's pretty standard, at least for as many years as I've been monitoring this regional economy. But for Southern Maryland to see that spike up is a really interesting phenomenon. And I don't have all the explanations for you on why that is, but it's substantially higher than you see Northern Virginia running at the moment. If we want to compare how we're doing elsewhere, certainly all the major job markets in the country have seen job losses. And as of November, if we look at this, we've been we've done relatively well. Normally when I present this slide, if we're talking about comparing, we've been somewhere in the middle, but you'll notice that we've retained. But interestingly, Houston, even though they have the added problem of drop in oil industry production, has done a little bit better, still dropped, but not as quite as bad as we had. Phoenix and Dallas and Atlanta continue to relatively outperform other markets. These are increasingly our competitors. I know that we have economic development folks in the region that talk about that their competition is New York and Los Angeles and San Francisco, and that is true. But increasingly, our competitors include Dallas, Charlotte, Phoenix, Atlanta. Charlotte doesn't appear in this because they're not among the top 15 in terms of largest markets. You also see that, interestingly enough, San Francisco, New York, Boston are among the biggest job market losses. Detroit, of course, is kind of continues to be a challenge, but it's really interesting seeing how much New York has gotten hammered by this. And this has been both a factor of economic activity, even though the financial sector has largely stayed intact and has actually grown some. The notion of New York, is this starting to give us some indications of people fleeing the area as opposed, when the pandemic hit? So that's just something I present now as a question as we move forward. District of Columbia, as a note on a proportional basis, this represents a drop in year over year as of November of about roughly 6.6%, give or take a tenth of a percentage point, I believe. So we've seen a substantial drop. And again, you just think about, if you look at that pattern of the blue lines going in, how many months, or in this case, how many years of job growth did we lose? If we had been averaging over the last couple of 3 years at somewhere around, say, 7,500 jobs or so, that means that we've got several years of job growth to recover. Now, some of it's going to come back in a surge, which we'll talk about later, but a lot of it is going to be, I think, lingering on a little bit. Southern Maryland had that really big hit. Their slope looks even worse with some level, but then they've really leveled out as the rest. Their job losses are in the 5.6, 5.7%. And then Northern Virginia, same kind of a story. Now, again, there are some structural differences in the economies between Northern Virginia, Southern Maryland, and the district that will shape forward-going performance. But I think it's important to understand that we certainly have some opportunities emerging, as well as, of course, the challenges that we've seen. Just because we're in Northern Virginia, I thought it'd be interesting to throw this one up about the that diversion between professional and administrative support waste management services in that sector, just to show here how Northern Virginia has continued to attract job growth in the professional sciences, technical sectors of the economy, and particularly even to see these spikes that are occurring in more recent, late summer, early fall time period. So let's shift a little bit to housing market trends. Some years when I do this presentation, I really don't cover much at all about housing markets, but housing markets have such an important dynamic in the economy. Now, some of that is I've just moved, and so I realized, think about this. Why is housing so important to the economy? Well, you get the construction activities, you get the financial side of the real estate transaction, realtors, mortgage brokers, things, folks like that. But also, I have now moved several times in my life, and I have not figured out a way of conducting one of these moves where I didn't wind up spending a whole lot of money. Your furniture never quite fits, so you need different furniture, or you need this, or you need that, or you're having to do minor repairs, or you're bringing people in to remodel something or whatever in the new place. It just sparks so much other spending going along in the economy. So it very much is a driver of a lot of different economic activity. Having said that, the biggest challenge that we have is this ongoing, almost continuing reduction in inventories of existing homes. What is for sale in the marketplace? And mind you, certainly the pandemic created a huge challenge on that. But if you can look at the way the seasonal patterns shape up in that data, but the peak of that line just keeps getting lower and lower and lower. And in fact, we've had challenges. I work with the Northern Virginia Association of Realtors on annual forecasts, and I bring in a group of folks that are real estate professionals from different sectors of the economy to different sectors of that market to talk and help me do that forecast. And we've had times that we really thought that the market was going to be even worse, because you can't make money selling real estate if you don't have something to sell. So inventories have been very tight. We saw a little bit, and this continues then to pressure other parts of our economy, because this means that young people who kept their jobs, that wanted to have young families who are looking for a home, are having a heck of a time finding properties. The people that bought our house in Fairfax County succeeded with us on their sale, and it was their 12th attempt to buy a house. They had lost out on 11 previous attempts to buy a house. And this is driving increasing frustration in some parts of our economy, or some of our workforce, because they simply can't find the housing that they would like to be in, even if they can afford it. And we still have affordability problems. And I'm not going to get into the sub-markets. There was an interesting piece of data, though, that I'll share with you about the inventories before I move into the existing home sales. We actually saw an uptick in inventories in September, October, in certain market segments, in particular, Arlington, Alexandria condominiums. So you're starting to see some effect, I think, that may be derived from the pandemic, where folks are not as keen about living in a building with a tiny elevator that you have to wait in line because only one person can get into the elevator because of its size, and you're having to go up, wait in line to go up to your 8-story condo. Or the other thing is, we have folks, and this will be the first time I mention it, but we're going to talk a lot about it at the end in just a few minutes, the work from home phenomenon. You were you had a condo in Arlington or Alexandria, but you had a place, a home, actual, say, a single family residential property someplace else. And now you've basically have just gone to that someplace else, and you've decided to put your condominium on the market. This is a little bit of anecdote that we're getting out of folks out of the real estate industry on that, but we're monitoring it carefully. I'm sorry, let me go back and actually talk about that slide for a moment. The existing home sales, you see the big drop, but it's actually gone well. And this is completely surprising given what was happening with inventories, right? So that just means that if you will, the number of homes or days on market has been shrinking a lot, because we continue to see the number of houses being sold accelerating here. Some of this, of course, gain was just a bounce back off of this drop, right? And once we started selling again, but you'll notice that that stayed pretty high even more recent months. And keeping in mind that the spike here are things that would have probably happened a couple of months earlier, but by the time the closing happens, a good 30 days, 45 days later. The median home price has certainly taken a little bit of an uptick because of this. I would tell you that home prices are still somewhat constrained by affordability, but the availability of very low interest rates and 30-year fixed rate mortgages has mitigated somewhat of the actual affordability problem. So there are folks that are, even though the prices have gone up and are at the edge, they qualify for a little bit more because of what's going on with interest rates. So now let's start talking about some outlooks and issues as we get ready to go into the Q&A session. Economic recovery, we're going to talk about talent, both in terms of worker attraction and retention, the phenomenons of work from home, just some thoughts that I have about that. We're going to talk about the federal government now that we know the outcome of the Georgia elections, the makeup of Congress is going to have an impact. I also want to spend just a couple of minutes just because it's a key issue moving forward as we're seeing the rollout of 5G technologies. I think that there are some things in the economic data that's going to change, but it's just something fun to talk about. And then I'll conclude before we get into the quick Q&A with just how do I see it all balancing out between this year and next year. So the recovery, well, for us regionally, federal spending, after seeing that dip down because of the Budget Control Act in the 2013 period where, we saw a couple of year drop down and then recovery on that. We've seen more recently some spikes, and this is in fiscal year data. So this is very much an indicator that we are going to continue to see federal spending rising and that federal spending will be in the region. I don't know the distinction, how we might, because of the congressional change, mix up between defense spending versus social services spending, healthcare, research, and all that. But the good news is that there is some part of our regional economy that will be able to capture that a portion of that increased spending. Here in recent years, Northern Virginia has captured a little bit of an outshare of it because we've really emphasized increasing defense spending. And even if that defense spending is meant to support a base operations in Norfolk or someplace else in the world, with the presence of the defense contractors that we have here, we're getting to take a little bit off the top of any of that as it passes on to different parts of the country. I think that phenomenon is going to continue. We're going to see increased probably spending and things that may actually help the Southern Maryland section of our economy more than the Northern Virginia. But again, Congress is very narrowly divided. And yes, Democrats have both sides. I don't know that we're going to see a massive shift. Now, the other thing, of course, it's going to be interesting to see about the issues about federal debt and federal spending. But for now, we're going to get, as Matt suggested earlier in his introductions, we are going to see more stimulus spending because the economy remains somewhat weak, and it's going to be a while before this pandemic effects are over. And nothing else, I foresee that somebody that is, I'm 60 years old, but I'm not particularly at a health risk, I probably won't qualify to get a vaccine until well later in the year. And of course, we have this one now that just came out in the news about the Biden administration wants to get more doses out in the first dose. I don't know what that means in terms of the availability of the second dose, because keep in mind, this is a 2-dose regimen. So I'm not sure how all that balances out about the speed of it, of the distribution. This chart, I think I have covered it, not necessarily every year, but what it shows us is domestic outmigration. We, for several years now in this economy, and we have a little bit of a data lag. So the most recent time period that we have data for this is from July 1st of 2018 through June 30th of 2019. So it's about a year and a half old data at this point, but we were seeing fairly consistent across several years of declining domestic migration. In other words, more people who reside in the US overall were leaving this region as moving to this region. Now, overall, we had population growth, but the population growth was because of of immigration and because of natural growth. So in other words, more births than deaths. Now, the net domestic migration, if you will, that's been a real challenge too. The net international migration, that's that lighter of the two green, and you'll see that number has shrunk in recent years compared to others. That has been a result of the Trump administration policies on immigration and the issuance of visas. So that's a very important segment of our overall population and overall economy. Keeping in mind that the immigrant population in our region has education attainment levels at about the same as the overall US averages. We are the most highly educated workforce in the nation, and I'm going to say that that's a good thing overall. We can debate the subtleties of that, but my point of showing this here is that if we have folks that are now leaving because of population density issues, because they're scared of this pandemic or maybe the next pandemic, or the housing affordability issues that we have because of the lack of housing supply, losing young workers, and I know we've talked about this before in session, young workers to some of these other markets, Charlotte, Atlanta, to a lesser extent, Phoenix. We certainly are not losing people to San Francisco by and large, although we're losing some companies out there. But basically understand that I would see this challenge becoming more problematic for us as we move forward, in part because of our population density and in part because of just the affordability of living here in this region. Let's talk about work from home for just a moment. So this is November data. I actually have a couple of data points that I can give for some December that I didn't have time to put into the chart. But we saw, if we have about 150 million people overall total employed, you can kind of see that trend that as much as 35% of us were working from home early. And that's overall. If you focus this down on just people with bachelor degree qualifications and above, that number was actually over 60% in the early part of this year in May, and then of course decreasing down a little bit. And you can see now that we're running about 25% of the population. The numbers more recently have actually grown up a little, or actually have increased a little bit. So now instead of something in about the 23, we're about 24%. So we actually have seen that number increase in the December time period, according to the most recent data that just got released. How we handle that going forward is going to be really, really interesting. In my situation, I've been running my center remotely since the very early part of March. Certainly there are some challenges that we have from time to time when I'm working with students that I'm not there to kind of, hold their hands working through a way of doing something. But if you think about it, we're adapting pretty well to some of this. And, is this as fun? Is this presentation today as fun as it would be if we were in person? No, but I would tell you that, we can make this work. So one of the issues that we have here is think about what is the trend of that going forward and how is our workforce going to change? And indeed, if you start thinking about economic development incentives have always been targeted to companies. What if we need to actually start incentivizing workers to stay in our region? What if we need to have active programs meant to help people stay in this area? Or if they're going to work from home and they have the ability, you start thinking about what is the shape of that? How do we help our businesses adapt? One of my colleagues that has a few employees now, about 20 employees, a fifth of his workforce is now out of state. So instead of filing his employment taxes and things for basically everybody in Virginia, he's now doing it in 4 different states, managing that process. Now, I'm not worried about a Lockheed or somebody like that managing workforce across, because they probably have workers in almost every state. But small businesses are struggling to adapt. And the other is you start thinking about the different kinds of work that we're doing. What jobs are going to be the ones that somebody can say, I still need you in the office 3 days a week? Their location is probably not going to change for that. But if they only have to be in the office, one day a week, well, then they can live further out and it's not a bad, they have a bad commute one day a week. But what if they only have to be in the office a couple of 3 days a month? We are starting to see companies that are saying, we will pay for your transportation cost to come to the office a couple of 3 days at one time per month, but we're not going to have an office for you. So we're going to reduce that 85 to 100 square foot of office demand space. So you start thinking about, how does this shape overall demand for office space? We were already seeing examples in this region where commuting times, companies were allowing workers to work from home just to get out of this horrible commute that we have in this region. So you think about it, proportion of our workers that spend 60 minutes or more, an hour or more commuting, we're at a little less than 20%. This data is somewhat 2018 data, so it's not the most recent. We're not necessarily as bad as Boston, New York, or San Francisco, but again, start thinking about, I noted that our competitors are increasingly Atlanta, Charlotte, Dallas, and if you look over there on the left-hand side, where are those? So much easier to get around. So as we're getting close then, the building permit data, we simply are not building enough housing to address the issue of housing affordability in this region. We've had just a little bit of a spike here recently, but if you think about it, we're just not building enough housing units. And of course, our cost of building in this region, because of all sorts of things, are challenging for us. I think what I'm going to do now is I want to allow plenty of time for Q&A. So let me just say this about 5G. 5G is the new, if you will, generation of mobile. It's going to allow ultra low latency, which means no lag in your data feed, so you don't miss the last shot in the basketball game or something like that because of buffering. But it also has the applications for medical, for telemedicine, and autonomous vehicles and things like that. It does require more infrastructure, but that infrastructure, that little picture I have there, is these little repeater things. So it's not like the big cell phone towers. Here's the point that I want to make with this, though. How are we going to use this? Enhanced mobile broadband, virtual reality, augmented reality in manufacturing processes, warehousing, distribution, faster, more uniform data rates. You think about the communications, both in terms of infrastructure, medical, the Internet of Things. All of these different things are going to change. The trick that we have, though, is that this technology is so new, we don't know all of the applications that we can come up with yet. So we're in a brave new world, but we're going to have to be very nimble in our economic development processes in this region and be working with businesses to help them adapt to new market opportunities that are going to come from this infrastructure. If you guys want to get more into that, we can do that in the Q&A session. But let's just say that I want to think here at the end about what we're going to do for our outlook for this year. Well, it's really about managing expectations. And indeed, I'm almost, and interesting that I come off of 5G with this, you may recognize this as a Gartner hype index, where you wind up with massive expectations and then you get the trough of disillusionment, and then you get some reality bidding. That's what I think is going to be recurrent. Look at what happened with the stock market. The stock market has been reaching all-time highs across all the major indices. We've been just continuing to have a very positive outlook about our recovery from this. I think the recovery is going to happen, but I think that the story of 2021 is still going to be pandemic influence. It's going to require massive government spending on this, which of course is going to accelerate the debt, which I would tell you remains a problem, as we've talked about before. The ubiquity of vaccination, not until the fourth quarter at best. And I think we're also still seeing this rising caseload rate coming out of basically a lack of discipline during the Christmas holidays. I appreciate folks wanting to do that, but that's the reality of it. How we adapt to these market conditions, our ability to attract and retain talent, what is going to be the work from home. And if we have less demand for office space, what's that going to do to revenues of local government that rely on those business property tax revenues, if you will, the real estate and other revenues like that. The federal share of the regional employment is going to grow, I think, because fiscal, they're going to continue to spend. I think that we've got a couple of years before we see the Republicans go back to their fiscal obstruction days. And I'm not saying they're not justified in doing that, given what debt levels are going to look like. I think that there's going to be some deployment, but the net effect is we're going to see growth, but I quite honestly do not see our region or our country getting back to pre-pandemic economic levels until late 2022 or early 2023. And with that, let's open it up for questions and answers. Thank you very much.
Thank you, Dr. Clower, for an informative and insightful presentation. We will now move to the Q&A portion of the webinar, and we have about 15 minutes left to address your questions. The first question that I have goes back to your job sector, job change by sector slide. And we have a participant asking about where you would put the moving and relocation industry, which category. Similar to Amazon, his business would be viewed in a number of fields and categories.
Sure. Well, if you're talking about the physical side of it, that's certainly in transportation. That's the trucks, the warehouses, the storage areas, and all of that. There are other elements, though, of the relocation sector, which gets into real estate. There's sectors of it that gets actually, though you don't formally see it categorized this way, for the folks that do that business, and indeed even in the real estate sector, how much of what they do really is almost financial advisory work or so. But typically speaking, the relocation sector is going to show up either in real estate or in transportation, or, and that real estate side would include the financial aspects of real estate. So that would be the average of it. But again, as if we're more mobile, or if we're able to work more remotely, you would expect that that's going to be a pretty good business to be in for some period of time, depending on what businesses want to do. Always keep in mind, we're talking about this work from home, but about 2.5 years ago, IBM came out with a directive telling their employees if they wanted to keep a job, they had to come to the office. So one of our big questions that we don't know is, what is going to be that permanent effect? I'll speculate to you that I think that we're going to see probably about somewhere between 8 and 10% of our workforce continue on a long-term basis to be relatively remote work, or at least commuting or not commuting, multiple times a week. However, I've got that's just a guess at this point.
Okay, thank you. As you know, the government or President Trump had signed into law a deferral related to student debt. We have a participant asking how you foresee future legislation impacting student debt.
I think this will be one of the areas that will pass relatively quickly through a Congress that is and a government that is controlled entirely by one party. I think we will see additional relief measures on existing student debt, and I think there will be both deferments and forgiveness on that. We can argue philosophically of whether or not that is right or wrong or should be done, but the fact of the matter is that I would very much expect that we will see some households, particularly millennial households, who will see their overall debt burden relatively. It's not going to completely change their debt burden, but it's going to substantially reduce it. That actually might allow them back into being into the home market.
Okay, and kind of staying along the same lines with legislation that has passed. We aren't yet out of the pandemic, but is there an early consensus on how well the government has done supporting the economy through the pandemic? And is there a consensus on responses the government could have done better?
That depends on who you think of in the consensus. If you do a consensus of folks like my colleagues who are epidemiologists and people that study the movement of disease, they would judge our responses on a national level as being pretty poor. If I were of persuasions, of the political persuasion that says that any restrictions on my activities is an impingement of my fundamental rights, then I would look at the other way. I think there is no measure that speaks to our philosophical divides in this country than what we are seeing, just the response to the pandemic. I've been, and I say this a little bit facetiously, but not completely, I've been doing the thing that it is to me, as a somewhat a libertarian, it's anybody's right to play Russian roulette, as long as the gun is pointed at their own head. I have a problem with people playing Russian roulette with the gun pointed at other people.
Got it. And do you foresee interest rates to rise in the near future?
So this is one of the interesting things that's we are starting to see indications of inflation pressures because of things like cost of materials based on demand and supply dynamics. I think that we could see some pressures on the Federal Reserve to be at least more thinking about inflation than they have thought about inflation in the last three or 4 years, quite frankly. Having said that, I don't expect much in the way of change of overall interest rates and long-term bond rates, because at the end of the day, we're going to maintain a very accommodative posture as we are struggling still to get economic recovery. Throughout the economic recovery, we're going to be accommodative on that. And beyond that, I would also argue that we'll still continue to see U.S. debt be particularly attractive on the international markets, because where else would you park your money?
Got it. Okay. Another question from a participant is, does it make any difference in the economy if the vaccines are massively distributed to the public for the first dose?
I think it probably would, and that we would have people out engaging. We would have some local and state governments that would use that as the reason to reopen their economy, and you would see some surge of it. But what I'm concerned about, and I am not an epidemiologist and I'm not a medical expert, so I'm straying a little afield, but one of the things that I could be concerned is, if you massively distribute the first dose without the allocation and the programming for the second dose, do we create another problem? The reason that I say that is I did work many years ago on issues of tuberculosis, and your problem is that tuberculosis in the modern era as a first treatment is relatively easy to treat. But if you break your treatment regimen, if you don't complete your treatment regimen, it will reemerge as a treatment-resistant varietal. What if we overdo the first dose before we have the supplies and the logistics set up to do the second dose? And I don't know of any research that says what happens if you don't complete that second dose when you're supposed to.
Right, I would agree with that. It seems like there might be a temporary increase in confidence, but that will quickly dwindle.
If the infection's spine, or if we wind up creating a circumstance where we have some drug resistant variation emerge, of the disease.
Right. So staying along the same lines, in regards to the vaccines, we have a participant asking, when the vaccines go around and the offices start opening back up, do you think people will start moving back into the city or stay out in the suburbs?
I think that we have two dynamics. I think that there's going to be, I think there may be an age thing. That in part that you will see, folks that maybe at the stage of their life cycle, they've got, maybe young kids and stuff that, it will be a little bit like it's always been, where, you know, once you have kids, you're more interested in having a yard for them to play in, simply because you don't want them running around the inside of the condo all day screaming and yelling. You like having a yard to send them to, you know, get outside, go play, kind of thing. There's a little bit of that element. I think that we're going to continue to see, as we figure out this balance of who can, you know, what jobs, what occupations really promote the ability to work remotely, but, you know, and effectively. But again, on a broad scale, innovation still happens best when we're face to face. This, you know, we're kind of getting adjusted to all the Zoom stuff, but it's not as spontaneous. And just cannot be by nature. So I think that we will see some pushback on that. The other thing is, we are social animals still. So the full dynamics of cities are still going to be very attractive for most of us. We're not all going to become hermits. We're not all going to become, you know, misanthropes and not want to see any other people. Having said that, some depends on us getting on top of this and getting it to where we're not afraid of the next pandemic. That, you know, will it happen again? Sure. Hopefully it's another 100 years, and us individually, we don't have to worry about it, you know, since the last huge pandemic. But I would tell you that the dynamism of cities, the availability of amenities, you know, entertainment. So what if we don't have to go to malls anymore for our shopping? That space can be reallocated for other uses, maybe for housing in some cases. But I do think that we will see cities still emerge and being the places. I do not see a massive shift in that trend of depopulation of rural areas. I think it will pause for a few years, but, you know, when we get on top of this and the economy gets back to growing again, cities are going to be incredibly attractive, particularly for young workers.
So as we all know, most of the schools in the area have been doing 100% virtual learning. So a participant is asking a question about what is the regional impact of schools not opening until fall 2021?
I don't know, but it's big. And it's big for 2 or 3 reasons. Some of them we will never really be able to measure completely. And here's how many, if you think about this, and this would be the fun part if we were face to face and I could be reading your expressions and stuff like that. But if we think about this, when this started and we started having to do things by Zoom, I found my productivity probably increased dramatically because I was putting 12, 14 hours a day in front of my computer screen. You know, particularly as I was having to run through very quickly and adapt my course materials to distance education and stuff like that. But nonetheless, many of us found ourselves actually not just recapturing the commuting time, we were working even more. Now, I think some folks have gotten better about a little bit of a better balance. So, you know, and indeed, I think we have a lot of folks that actually are really probably experiencing burnout, you know, and just because we've put so much time in, because we don't have that balance of our, you know, of what's work and what's home, and that little bit of a break that you get into the commute, if you think about it that way. The other thing that we won't measure is our loss of productivity, because particularly where kids are at home and you're having to, you know, and somebody has to supervise them. There was an article in the Washington Post a few months ago that was a great op-ed piece done by 2 professors, a young family, both of them were professors, and they actually were measuring. They had 2 kids, one who was, I believe, like 9 years old and another that was a preschooler. And so the parents basically said, somebody is on duty. Tell the kids, if you need something, this is the parent you go. And they would trade that off so they could do their work. The parent who was not on duty never experienced a period of time of more than 17 minutes without being interrupted by one of the kids. And not saying that the kids weren't, you know, asking questions they need one, but with the kid, you know, this stuff about the work at home. And indeed, this really, one of the things that it really pulls to attention to the middle income and upper and lower upper income households that they really had never fully appreciated is the issue of childcare and how we are handling childcare in our society, and the economic burden it is on childcare. There are households that can afford it that have basically have gotten together and say, 3 or 4 households, 5 households, something like that, and are actually trying to do things, collectively. But we will never be able to measure the productivity losses that we have had in our economy because of kids being at home. And then whether or not, how long does it take us to catch the kids back up? Because we have increasingly educators that are telling us that children are losing an entire year's worth of learning. And how you measure that in the broader economy is very difficult.
Okay, we have time for one last question. What impact should we expect to see from the massive debt we have taken on to stimulate the economy during the pandemic?
Sooner or later, interest rates are going to rise, and they're going to rise sharply. That means that borrowing costs increase for businesses and individuals, and that's going to slow overall economic performance. Now, I must caveat that with the response that I do not subscribe to this modern monetary theory that debt doesn't matter. Debt matters. And we have accumulated debt. What was interesting is that we had a Republican, supposed to be financially conservative administration. We had the Republicans had both houses for 2 years of the last administration, and then we had a split, and yet federal spending kept increasing. Now, I shifted about what it was being spent on, but we've incurred massive debt in 2019, 2018, when the economy was running arguably on all cylinders, when it was, according to the president, was the best economy ever. I don't know if it was the best ever, but it was a very good economy. And yet we continued to increase that. One of the things I would tell you is that, again, it's another piece of evidence that trickle down economics just doesn't seem to work. We tried it in the 80s. We now tried it in the 2000s, and neither time has reducing tax rates, particularly in the corporate sector, caused so much growth in economic activity that it made up for the tax loss. Now, having said that, I'm not a big fan of tax increases. I love having lower taxes, but the fact of the matter is, unless we want to be completely selfish, we've got to get our fiscal house in better order, or our children, our grandchildren are going to have lower quality of life as a result.
Okay. Well, thank you so much, Dr. Clower, for today's presentation, and thank you to all of you for attending our presentation. Please be on the lookout for an email that will contain a copy of today's slides, as well as a recording of today's presentation. And I hope you have a great rest of the day. Thank you for joining us.